Hi and welcome to Swissquote's Daily Market Talk. We are Friday, December 19th, in the wake of the first CPI inflation data release in the United States after the US government shutdown. The report was good, but a bit too good to be true, and so good, in fact, that it raised many eyebrows. Equities gave back earlier gains as investors dive into the numbers and the US dollar surged after the data. So in short, the signal that we got here was quite noisy and didn't necessarily provide much visibility about the Fed's next move. Elsewhere, the European Central Bank held its rate steady yesterday. The Bank of England cut and the Bank of Japan hiked the interest rates. The FX moves were, however, clouded by a broadly stronger US dollar across the board, and Santa really looks quite bruised this year, yet not fully called off. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. I almost started believing in Christmas magic after seeing yesterday's US CPI numbers. Have you seen the data? The headline inflation fell from 3% to 2.7% in November, whereas the expectation was a rise to 3.1%. And the core CPI fell from 3% to 2.6%, versus the expectation that it would remain sticky around the 3% mark. The data was a big surprise, a bit too big probably to be true. And indeed, the backstage was a bit messier than the beautiful and shiny headline figures. In fact, the October data was missing on most components. EY Parthenon even called it the Swiss cheese CPI report due to the holes in that report. And missing components included, among others, one major driver of prices, shelter costs, which make up about a third of the US CPI index. No wonder if you take the shelter cost inflation out, the life is cheaper. And one more thing that you need to know about this data, the missing data was being treated as no price growth at all for that period. So you see the result, right? A major drop in US inflation that almost matched Donald Trump's claim that the cost of living crisis in the United States is a hoax. For me and many economists, this is just a scandal, and some people even say that someone needs to get fired at the BLS today for making such a big statistical mistake. So all in all, Tuesday's jobs data suggested a softening but not a collapsing jobs market in the US, and yesterday's CPI data didn't give a clear guidance on US inflation numbers. The result? We don't have a clearer answer today about what the Fed should do next than we did before these data releases. Now, some still point that the shelter costs in the US are still trending lower and that the latter will have a disinflationary impact in the coming months, but perhaps not as fast as yesterday's data suggested. Because it will also depend on energy costs, right? They're rising these days. US gasoline prices were up modestly over the year, but fuel oil prices in the US jumped 11% compared to a year ago. Electricity costs rose near 7%, and natural gas prices passed 9%. And the rise in energy costs was one of the major drivers of inflation in the post-pandemic period, remember? So the conclusion is that it's too early to call the end of inflation in the US. Now let's look at the market reaction to the data. Despite the inaccurate nature of yesterday's CPI print, the side of that soft inflation figure made investors happy, at least for a short moment. The US 2-year yield sank below the 3.45% level before rebounding obviously to where it was before the data as people just realized what was going on behind the scenes. The US 10-year yield flirted with the 4.10% level as well, but rebounded as well, and the probability of a March interest rate cut from the Fed rose from around 50 to closer to 60%. The S&P 500, on the other hand, rallied with joy just after the data release, but gave back most of the gains to close the session close to where it opened. It still rose some 0.79% yesterday, though. The small cap index of the US first outperformed the bigger size peers, but also ended by giving up gains as the session went on, and the US dollar reversed earlier losses and is better bid this morning in Asia across the board. Yet note that beyond this imperfect CPI report and October holds, I am still gently coming to believe that the US inflation could fall without having showed that much expected tariff impact on data. If that happens, it will be like the US recession that never showed up despite that 26-month inversion in the US 2 to 10-year yields. Remember, 26 months of inversion and nothing, no recession whatsoever. So this could be going toward that direction as well for the inflation data. I know that the feeling in the main street is not quite the same, but if it's any comfort to anyone, the Swiss inflation is at 0%, while we've seen double-digit surge in health insurance costs for years now, which is a big chunk of the consumer basket as well. So the data doesn't necessarily match how you feel in the street. So if the tariff-led inflation never shows up in the economic data and the US jobs market continues to weaken, there are two options. Either investors believe in the data and send stock prices higher, or they believe in the Fed and they still send stock prices higher. The question is, will there be a blip on the road? I guess we will see. Funny enough, the market and the macroeconomic backdrop is not necessarily bad for risk-taking. AI appetite is sure questionable, but the Fed expectations are dovish, liquidity good, and potential for a rotation from technology to non-technology strong. So there is still hope, guys, that the things turn out to be well. Elsewhere in Europe, the news were more traditional. In Europe yesterday, the ECB held rate steady at the final policy meeting of the year as widely expected by everyone. The ECB raised its growth forecast for 2026 and 2027, insisted that inflation will only be getting to the 2% target in 2028, and that there is too much uncertainty for the bank to set a rate path. In plain English, they said the rate cuts are probably over for now. The euro-dollar weakened, but it weakened because the US dollar gained broadly. Across the channel, the Bank of England cut interest rates by 25 basis points, as widely expected as well. But here the vote was surprisingly close to call, just 5-4 in favor of a rate cut. I, as many out there, was hoping that the recent easing in UK inflation and the disinflationary budget would convince some hawks at the MPC to join the dovish camp. But apparently, disinflation didn't look that straightforward to many MPC members in the UK, so Cable printed large swings on the combination of an unexpectedly more hawkish Bank of England stance and that questionable cooling of the US inflation. But the pair is pressured lower this morning as the euro-dollar because the US dollar is broadly better bid. Elsewhere, Riksbank and Norges Bank also kept their monetary policies unchanged yesterday, and the Bank of Japan raised its interest rates by 25 basis points to 0.75%, as widely expected by everyone as well. That's the highest level since 1995. Plus, they didn't forget to mention that the real interest rates in Japan remain significantly negative and that overall financial conditions are still broadly accommodative to ensure continued support for economic activity in Japan. And all that resonated in investors' minds as there will be more interest rate hikes in Japan in horizon. So the 10-year JGB yield shot up to 2% after the decision. That was not great news for global risk appetite. Because remember, the higher the Japanese yields, the higher the chance of big Japanese buyers like insurers and pension funds who are big US Treasury buyers bringing their capital back home to Japan. But the dollar yen interestingly rose. The US dollar's appreciation weighed heavier here as well than the rising Japanese yields that totally failed to attract the Japanese yen bulls today in Tokyo. So whatever happened elsewhere, it just came down to Fed and a dollar story. And before we say goodbye, I would like to remind everyone one more thing. It is that the Fed's dovishness alone could provide enough fuel to the entire world and counter what other central banks do anyway. And even though the Federal Reserve those are scratching their heads after this week's data, the Fed's outlook is still softening compared to most major central banks that are actually expected to pause their interest rate cuts next year. So don't be sad. The Santa rally looks increasingly compromised, yes, as we are moving into the Christmas week. The data and AI appetite are not necessarily encouraging, but the rally is still not completely called off. So this is all for this week. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please Do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.